In today's class, okay, in today's class, we shall continue with our lecture on adjusted present value. Hopefully, we move to option pricing. Right, option pricing is another interesting topic as well. So please, can someone give us an overview of what we discussed or what was discussed in our previous lecture? A quick one, please. Away. I'm waiting. Oh. Okay, so it seems let me call him now. And then, Bashirat. Bashirat.
Good morning, sir.
Good morning. Okay, please, I want to hear from you. Um, just an overview of what we discussed on adjusted present value. I'm sure you're in class now, so.
Yes. Okay, we look at adjusted present value. And we said adjusted present value, it's considered all relevant cash flow, unlike the normal MPV that we used to do. So that won't consider all relevant cash flow. So and the third format for it is that we first calculate the base case MPV. Then once we have gotten the base case MPV, and that base case MPV is similar to normal net present value that we used to do. Then after that, then we look to the PV of financing effect. So once we are done with base case MPV and the PV of financing effect, then we get our adjusted present value. Then for the PV of financing effect, that one also has various steps that we are going to consider. That the one of subsidized loan, the one of commercial loan. And also mention that we are going to use the commercial rates to discount the PV of financing effect. And then for base case MPV, we are going to use the cost of equity of the ungeared company to discount the project or the investment. So once we have done it and we have followed the various processes for base case MPV and for PV of financing effect, then we get our adjusted present value.
Okay, that's fine. Thank you. Taib, thank you. Taib.
Sir, I'm with you, sir.
And tell us an overview now of what we discussed in our previous class. Even me, I'm with you. I'm always with you. I'm always with you.
Like where I am is kind of noisy, sir.
Okay. Okay, don't worry. Okay, that's fine. Okay, a quick recap on adjusted present value before we solve illustration 3 on the material. Right. Adjusted present value considers all the sources of finance, meaning that when a company wants to embark on a project, in calculating the APV, you need to consider all the sources of finance, right? In considering in calculating adjusted present value, there are two items. One, the base case NPV and the PV of financing effect will give us adjusted present value. Now, the base case NPV make use of the relevant cash flow, just like the usual, what is it called? Net present value, right? But what you will use to discount it is the cost of equity of the ungeared company. That is the cost of equity of the ungeared company, that is the PROSI company. Now, in determination of the cost of equity of the ungeared company, there are two approaches. You need to check from the question. There are two approaches. The first approach is to identify the PROSI company, then determine the better assets of the PROSI company. That is, calculate the assets better. Then use the assets better calculated to determine the cost of equity of the ungeared company using CAPM, where your assets better will become your equity better. Don't forget, this is an assumption that the project will be financed by equity. Having explained this, then you can now use, or you use, the Modigliani and Miller assumption, preposition 2, where it is also assumed that the project will be financed by equity. The formula is the cost of equity of the geared company equals to the cost of equity of the ungeared company. Don't forget that that is what you want to calculate. That is what we want to calculate, right? The cost of equity of the ungeared company minus the cost of debt of the PROSI company. The market value of debt of the PROSI company, the market value of equity of the PROSI company, the tax of the PROSI company. You'll be given in the question that the cost of equity of the PROSI company is this. That will be the cost of equity of the geared company. Then you have to make KEU the subject of the formula. That is, let S represent KEU. So you need to look for, check which of this approach, based on the examiner, based on the question, check. If you look at it that Modigliani and Miller cannot work, switch, quickly switch, right? Move to the next one. Use the first approach. And that is why I gave two approach. To calculate the cost of equity of the ungeared company. I haven't explained this in our previous lecture. We equally examine the PV of the financing effect. That is the second item. So when you use the cost of equity of the ungeared company to discount the project, then you need to calculate the PV of financing effect, which consider the sources of finance. Class, the question now is, what should we use to discount the PV of financing effect? That is the commercial rate or the cost of debt of the main company. Now, this table is just, these are the steps you need under the PV of financing effect, the sources of finance. You'll be given in a question that they need to purchase machine of 500,000. How will they finance this project, machine? They have to borrow, maybe from the government as a result of subsidized or cheap loan. And they equally use what we call equity. And when you are using equity for a sources of finance, it is right issue. And I equally explained in our last class that right issue means that you are issuing a shares to the existing shareholder below the market price. I gave a practical illustration to that in our previous lecture, a case study of UBA. As an existing shareholder, you can decide to exercise your rights, or you do nothing, or you sell part of the rights. If time permits us, we'll take that part of the sources of finance. Meaning that the equity finance is right issue. And it's going to cost the company. What we cost the company is what we call issue costs. Class, you need 50,000. For you to get 50,000, it will cost you 10,000. The total of the gross amount needed is 60,000. The 10,000 is what we call issue costs. And it is assumed to be in years old because you've not started the project, you just borrow. Then, when you start the project, we will now have what we call the tax savings on issue costs. And the examiner may state in the question that tax is allowable on issue costs on debt, or tax is allowable on issue costs on debt and equity. Fine. But when the examiner is silent about the tax savings on issue costs, you can assume to be on the commercial debt or the two debts given to you if the company wants to finance the project entirely by debt, which is the cheap loan and the commercial. So when the examiner is silent, you can assume that the tax savings is on the tax savings on issue cost is on what? Is on debt, commercial debt. Class. So it is assumed to be year one because you've commenced the project. Then tax savings on interest costs. What is tax savings on interest costs? Class. You use equity to finance a project, you want to use equity, which is right issue to finance a project, then you want to use debt. Under the debt, you have the subsidized loan and subsidized loan or cheap loan and the commercial rate under debt. Then, of course, there will be a rate that will attach to it that if the MPR as of today, the monetary policy rate as of today is 27.5%, right? Bank will be lending at 30% to 32% basis points. What is the commercial rate? It is the 32% basis point. When they are given 32% basis point as commercial rate, government can decide to come and tell you that, don't worry, we will give you 5% below the commercial rate. Class, what is 5% below the commercial rate is 17%. Is that also, is it 17? Or 5% below 32 is what, class? Is it not 17? Now, 5% below the commercial rates, right? We give us the subsidized rate. Then there will be a rate for the subsidized, maybe 3%. Then the commercial is 5%. How much did you borrow? The rate times what you borrow times the tax. We give us the tax savings on interest costs. Now it now depends on how the tax is being paid. Is the tax being paid in arrears or in the year at which the profit is being made? This is 11:30. So in our previous lecture, we also explain, we look at an illustration on the PV of financing effect on savings on interest. If the government is saying we will give you 5% and you will get it at a commercial rate of 2%, how much did you save? How many percent did you save? You've saved 3%. Class, this 3% that you save, it is an inflow to you. So therefore, you need to multiply it by the amount you save. We have what we call savings on interest costs, on interest. Of course, you already made, you have an, you've already saved money. You have to pay tax. And that is what we call tax paid on interest saved. Then you calculate your PV of financing effect. Then the base case NPV plus or minus the PV of financing effect, we give the adjusted present value. And these are the steps you need to know under the adjusted present value. In today's class, this is just a quick recap, right? In today's class, we shall look at an illustration, right? I think we solved question on illustration. We did in illustration 1. Now, please, illustration, John Tayo is your assignment. Please make sure you do it. You attempt it. John Tayo. And the pilot question. John Tayo is your assignment and attempt the pilot question as well, question 1. Now, let's quickly solve this question, illustration 2, before we move to option pricing. Class, do we have anyone that have question for me before we look at this illustration? This question is adopted from. If you have question, quickly unmute your mic. Okay. Please, who will read? Illustration. Okay. Thank you.
John Tayo.
Yes.
Okay, let me go to requirements.
Okay.
Okay.
Can you see?
Research. Acting as an external consultant, you have
No,
been asked.
not John Tayo.
Okay, which one?
FPLC.
Okay, question number, what is that? Okay, number 2.
Yes.
Okay, you are required A, calculate the adjusted present value for the project, correcting any error made in the net present value estimate above, and conclude whether the project should be accepted or not. Show
Now,
all relevant calculations.
Thank you. Now, when you just see a question like this, please, when you see a question on strategic financial management, the first thing you need to do, you don't need to rush to solve question. Please, you need to understand the question, because research shows that if you understand the question, right, it is assumed that you've solved 60%. Once you understand the requirement, it is assumed that you solved 60% of the question. So please, immediately you read the requirement, understand the requirement. Don't just assume that because it is portfolio theory or option pricing, you jump to it. No, understand the examiner point, please. Now, when you see a question like this, the first thing that should come to your mind, okay, the topic. What is the topic? Oh, the topic is on adjusted present value. The next question you should ask yourself is, what are the steps? The base case NPV and the PV of financing effect. The next question you should ask yourself is, in determination of the base case NPV, what are the ingredients you need? What are the ingredients? Oh, base case NPV make use of the normal cash flow, right? Just like NPV. But you use what? The cost of equity of the ungeared company. Now, you ask yourself another question, that now the first thing you need to do is to identify the cost of equity of the ungeared company. Then before you now look for the relevant cash flow. When you are done with that, you'll be looking, as you are reading it, you are looking for the PV of financing effect, how they want to finance the project. Right? Please, you can go ahead. Go ahead, Madam V.
Okay. Your company, FPLC, produces and sells high-quality tomato paste in Kano. Hello?
I'm with you.
Okay. The product is sold locally across the country and exported to a number of African countries. Following recent government policy on rice importation into the country, the company is now considering setting up a rice mill in Kaduna State.
Okay. Now, setting up, following the recent government policy on rice importation into the country, the company is now considering setting up a rice mill in what? In Kaduna State. they are still in the same, it is still, they have tomato. It is a different line of a business. What they are selling is tomato. Now, because of the government policy on importation, they need to start producing rice in Kaduna, right? That is so they need to be looking for a similar company that is actually in that industry, so that they can use their asset better, and as well as the equity better. Don't forget, it is always a listed company. Okay, go ahead.
Okay, the following net present value estimates has been made for the project. Net present value is negative
Oh.
32.85 million. And therefore, the recommendation is that the project should not be accepted.
Thank you. Now, they've calculated, I don't actually know, we don't know the person that projected this, and they have a negative NPV. And therefore, it was recommended, as a result of that, that the project should not be accepted. Okay?
Okay. In calculating the net present value of the project, the following notes were made. 1. Since the real cost of capital is used to discount cash flow, neither the sales revenue nor the direct project cost have been inflated. It is estimated that the inflation rate applicable to sales revenue is 8% per year, and to the direct project costs is 4% per year.
Thank you. As a project finance officer, you want to do a project like this, and you want to embark on a project like this, and you are not considering inflation. That is a red flag. You need to consider the future of the project by incorporating inflation. And what we have here in the computation, there is no inflation. Inflation has not been the figures have not been inflated. So all these figures given to us here are all what? Are all what is it called? Are all real cash flow. Is that not so, class? So until we inflated it, it becomes, when we inflate it, it becomes what? When we inflate it, it becomes what, class?
Money cash flow.
Okay, money cash flow. Okay, thank you. Thank you. So next, so we need to inflate the sales and direct project cost. Right.
Yes, number 2. The project will require an initial investment of 760 million. Of these, 320 million relate to plant and machinery, which is expected to be sold for 80 million when the project ceases, after taking any taxation and inflation impacts into account.
Okay, thank you. Now, the project will require an initial investment. This is what they need, 760 of this, of which 32 million out of 76 million will be for plant and machinery. Then it will now be sold. The plant and machinery will be sold at 80 million when the project ceases, after taking any taxation and inflation impact into account. Now, from this 1 and 2 here, you can see that they are still talking about the base case NPV. Is that not so? They are still talking about what? The base case NPV. So this is where you will now start noting, okay, you have to inflate this, you have the sales proceed and all that, right? Okay, please go ahead.
Okay, Roman figure 3. Tax allowable depreciation is available on the plant and machinery at 50%. In the first year, followed by 25% per year thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. FPLC pays 20% tax on its annual taxable profits. No tax allowable depreciation is available on the remaining investments assets, and they will have a near value at the end of the project.
Thank you. Now, the tax allowable depreciation, which is the capital allowance, will be 50% in the first year. Then thereafter, you have to use 25% on reducing balance basis. A balancing adjustment is available in the year the plant machinery is sold, meaning that the year at which they sold the machine, they will have either balancing, they will have a balancing adjustment, either balancing allowance or balancing charge. And don't forget that they sold the asset at 80 million. Right? Now, FPLC pays 20% tax on its annual tax savings taxable profit. No tax allowable depreciation. They pay their tax on an annual basis, so it is not in arrears. No tax allowable depreciation is available on the remaining, meaning that when they have the project will cost 760, and out of 760 we have 320. Is that not so? Now, what is the remaining balance? 760 minus 320. What do we have? 760 minus 320. What do we have? 440. 440. So meaning that the remaining investment asset, it is not allowed for tax purposes and it has no residual value. Okay. Next.
Okay, number 4. FPLC uses either a nominal cost of capital of 11% or a real cost of capital of 7% to discount all projects, given that the rate of inflation has been stable at 4% for a number of years.
Okay. Now,
number 5.
Thank you.
Interest is based on FPLC's normal borrowing rate of 150 basis points over the 10-year government yield rate.
Okay, thank you. Now, let me pick it up from here. The nominal costs. This is the nominal cost of capital, which means immediately you inflate it. It is the nominal cost of capital that you will use to discount the project, because money cash flow goes with money cost of capital or real cost of capital. And that is the reason why you see real cost of capital. They use real cost of capital of 7% to discount it, because these cash flow here are real. No inflation has been affected, right? And we don't even know the person that prepared this. In a project finance where you are bringing interest, is not a relevant cost. Interesting. So my point here is they use real to discount because the cost of the cash flow given to us are real. So we are going to use money to discount the project. Class, if I can still want to twist this question, they will not state the money cost of capital. They will tell you that they have a real cost of capital of 7%. So meaning that when you inflate your cash flow, you cannot use real cost of capital. Please don't forget this. You need to use money. So therefore, you have to convert your real cost of capital to money cost of capital. Should in case you have, the ICANN may not give you maybe the nominal cost of capital, or the examiner may not give you the nominal cost of capital of 11%. So in this case now, we're given the nominal cost of capital already, so that we can inflate, we can use it to discount our projects. And we're given the general inflation to be 4%, right? We're given the general. In fact, if we want to do work back, say, can even convert it to a half 11%, but that is by the way, sure. Now, the next one is interest is paid. Interest is based on FS. Now, this is when the borrowing, the PV or financing effect, you start to look for the PV or financing effect in your question, class. Now, interest is based on FPLC normal borrowing rates of 150 basis points class, I've explained this, that when you have 150 basis points, you have to convert it to a percentage. It means 150% is 1.5. 90 basis points means 0.9. 30 basis points means 0.3. Now, over the 10-year government yield rate. So this is the amount they borrow. This is the rate at which they borrow over the government yield. We'll get there when we get to the PV or financing effect. Okay? At the beginning of each year, FPLC will need to provide working capital of 20% of the anticipated sales revenue for the year, meaning that there will be a working capital of 20% of anticipated revenue. The anticipated revenue is the revenue you inflated, right? Is the revenue you do what? You inflated, which is what? Which is 20%. Now, then any remaining working capital, of course, working capital are what you use to finance the project, right? So any remainder will be released, of course. Maybe at the beginning of the diet, I gave NextGen, for instance, 50,000 for finance, for data, and for all other expenses. At the end of the diet, I have to meet the registrar, right? I have to meet Christy. Oh, Christy, I borrowed NextGen 50,000 at the beginning. Then please, you reimburse me. At the end of the diet, I will receive my what? 50,000. So that is working capital. And at the end of the project, you have to recoup back or what? Back your investment. You can see this part is talking about the base case NPV. Why this is the only part that just mentioned the PV of financing effect. Now, it is anticipated that the project will be financed entirely by debt. Class, this is where the PV of financing effects come to play. So, class, please and please, even last diet, I told the student, right? We are all professional colleagues, right? And I usually say it that I just have the privilege to take strategic financial management, and many of you can do better, honestly, right? So please, when it comes to the PV of financing effects, please pay attention to that part. Although the examiner wants you to understand how a project is being financed. Now, in this question now, you should always pay attention to the PV of financing effect, because the examiner wants you to unlock something. But when you don't get the understanding of the PV of financing effect, you may miss it. And with that, may actually reduce your mark. Now, the project will be financed entirely by debt, which is 60%. When they say a project will be financed by debt, entirely by debt, meaning that including the working capital will be financed by debt. Because how did they want to get, if they say project will be financed entirely by debt? If the project is financed entirely by debt, it includes the working capital, because they don't have where to source for finance. They have to source for it through debt. So 60% of which will be obtained from a subsidized loan class, including the working capital and the cost of the investment, will be financed entirely by debt. So meaning that no equity here, everything will be financed by debt. 60% of which will be obtained from a subsidized loan scheme run by the government. There's a subsidized loan scheme here that is being run by the government, while the 60% of it will be financed entirely by debt. Which lend at a basis point. What is the lending rate? Class. Which lends money at a rate of 100% basis points below the 10-year government debt yield rate of 2.5%. Class. They've lent at 100 basis points. 100 basis points means what, class? 100 basis points means what? How many percent? 100 basis points means how many percent?
1%.
1%.
100%.
Thank you. 100 basis point, 100%, that is one. Which will give you 1. Is that not so? 1%. Right. Now, when you have 1% below the 10-year government debt yield rate, meaning that the normal rate should be 2.5. But Mukuna, no worry, we will give you guys 100 basis points below it, below the 2.5. Then you now do 2.5 minus 1%. We give you 1%, 1.5, right? It will give you 1.5%. Is that not so?
Yeah.
It will give you what? 1.5%. And that is the subsidized rate. That is the what? The subsidized rate. The normal rate is 2.5, but we will give you guys what is it called? We will give you guys 100 basis points below it. That is 1.5. If you look at it before this, they gave us that the interest is based on normal rate. If you do 150 basis points, we give you 1.5%. And that is what this part is still, what is it called? Referencing. Right? Plus. Now, you should not forget, if 60%, they said everything is financed entirely by debt too, but government will subsidize 60%. The remaining 40% will be financed by what, class? By what?
Commercial.
No. Thank you. Commercial. No, not equity. Not equity, because the project will be financed entirely by debt. By debt, including the working capital. So when you have a subsidized, you will have a commercial rate. Sometimes you will have equity, subsidized, and commercial, just like the first question we solved. Issue costs related to rising the finance are 12% of gross finance. Issue costs. Now they're giving us the issue costs. They didn't tell us, because the question said, if you look at it, there is no equity. So that means that this issue cost is on debt. And the project will be financed entirely by debt. So meaning that the 2% will be applicable on the subsidized and the what? And the commercial. And we should not forget, The tax savings on issue cost is always on commercial debt. On debt, let me don't say commercial debt, on debt. But when a project is being financed entirely by debt, so you have to include the subsidized and the commercial. In the previous class, they said the issue cost is on commercial. We move like that. When examiner is silent, right, it is assumed that the issue cost is on debt. And what are the debts that were given here? It is the subsidized and the commercial. Now, oh, the remaining 40%, okay, they even mentioned it. The remaining 40% will be funded from FPL normal borrowing sources. The remaining 40%. And what is the normal borrowing sources? Is commercial. That is the normal. The remaining 40%. If you subsidize for 60%, the remaining 40% normal, everybody will go to the bank and borrow. It is the normal borrowing source. I always like to analyze the question so that when we start solving, it will make it easy. We'll just pick information. You can see this part now is talking about the PV or financing effect. It can be assumed that the debt capacity available to FPLC is equal to the actual amount of debt finance raised for the what? For the project. What is the examiner point here? Is that they have the capacity. The capacity that they have to borrow, it is still equals to the amount they need for the project. That is what it means. The amount of debt they need to borrow, the amount of money they need to borrow is equal to the amount at which they need to finance a project. And this is talking about the financing effect. FPPLC has identified a company, KPLC, which operates in rice milling industry, right? In rice, they've identified KPLC as the proxy company. I always want to analyze, most especially adjusted present value. I always want to analyze each of every paragraph. They are very important under adjusted present value. So that is the reason why I always want to analyze it one after the other to understand the examiner points. KPLC is financed by 40% shares. 40%, 40 million shares, trading at 64 naira each. Class, what is this 64 naira? What does this mean? This 64 naira. Thank you. God bless you. Thank you. That is market price. Let me complete it. God bless you. Right? That is what, yeah, that is what the market price. You can see the level of gearing is not given. They didn't tell you that market value of equity is this. They gave you in form of naira, just like the way we normally do it under the cost of capital. How do we determine the market value of equity and the market value of debt? Under the normal with cost of capital. We should not forget that. And 68 million debt trading, 94 naira per 100 naira. This is the nominal. This is the market price of the debt. KPLC equity beta is estimated at 1.5. That is the equity beta. The government yield on government treasury bill. What is treasury bill, class? What is treasury bill?
Spirit.
Thank you. And it is estimated that the market risk premium is 8%. Then KPLC tax rate is 20%. Both FPPLC, this part is talking about the Proxy company. Both FPPLC and KPPLC tax in the same year as when the profit is earned, no in arrears. Calculate the adjusted present value. So this is a solution. The name of the company is FPLC. Now, we need to determine the costs of equity of the ungeared company. Now, looking at this part, which of this approach are we going to use to determine the cost of equity of the ungeared company? Looking at this information provided, class. The first approach, is that also?
Yes.
The first approach. So approach 1. Why is it approach 1? They didn't tell you that the cost of equity of the company is this. So we need to use approach 1. The first approach, which is this. Right? Which is this. So I have to copy this. Approach 1. Since we've understand the question, it will not take us much time to finish, right? So the Proxy company. What is the Proxy company? Name of the Proxy company? KPLC.
KPLC.
Right? Now, from the information given to us, is there anything like better depth of the Proxy company? Let's check.
No.
Thank you. No better depth of the Proxy company. So therefore, we forget about this part. The right hand side, everything will be equals to 0. So we make use of the first one. BE, equity beta. So what is the equity beta of the Proxy company?
1.5.
1.5. The market value of equity. How do we determine the market value of equity?
40 million times 64.
Thank you. 40 million, should in case you were given the nominal value, 40 million shares. 40 million shares. You can mute your mic. 40 million shares times 64 naira per share. Class, should in case you were given the value, if you are given the value, you need to divide it by the nominal value so that you have the numbers of shares. Don't forget, just like the way we normally calculate the value of equity under the cost of capital. Please. 40 million shares. What do we have here?
2,560,000.
2 million
560,000.
560,000. 2 million coming. Mary.
Sorry, I wanted to ask, if the asset corporate debt was risk-free, would you have used the risk-free rate as the BD?
No, if no. There are two different things, right? Better debt is different from the corporate debt. The corporate debt is cost of debt. Do you understand? If they say something is cost of debt is different from better debt. Do you understand?
Yes, sir. Thank you.
You're welcome. Just a minute. I actually forgot to take my note. So the next one, what do we have? The value of debt. The value of debt, you can see we're given the value 680 and the market price. So how do we determine the market value of debt, class? How do we determine the market value of debt, class?
You said the
We did-
680 million divided by 100, multiplied by 94 naira.
Thank you. Divided by 100 times, what is the market price per one?
94.
94. 94. What do we have here? What do we have?
639.2.
639.2.
Yes. 0.2.
Right? So they use the same tax. What is the tax rate of the Fuzzy company? 20%. 20%. So therefore, we can have assets beta equals to equity beta of 1.5. The value of equity, then the value of equity, the value of debt, the tax rates. Class, what do we have? What is the asset beta?
1.25. 1.25.
1.25. Then, what does class? I want to ask a question here. What does asset beta measures? Or what is the difference between the financial risk, the business risk, systematic risk, and unsystematic risk? I'm waiting.
Good morning, sir. Good afternoon.
Good afternoon.
Asset beta measure the risk of the investment risk of the industry.
Okay. So asset beta measures business risk, right? Is that not so?
Yes, sir.
Okay. What is systematic risk? Class.
Those are the risks that cannot be avoided. Avoidable risk.
The risk that cannot be avoided. You can also call it a market risk. A practical illustration is the inflation rate, the unemployment rate, and the exchange rate volatility. That is systematic risk. These are just 2-mark questions. Then, what is unsystematic risk is the opposite. So we can continue our lecture.
Please, sir, systematic risk. Just one more, please.
Who is that? Please, who is that? Who is the person that said just one more? Identify.
It's a Folonsho, sir.
Following show. We've done this thing before. Can check on the adjusted.
All right. Okay.
Yeah, thank you. So, what is our risk-free? The risk-free rate is 2% plus your asset beta will become your equity beta. What we're given here is the market premium, which is 8%. The difference between the market return and the risk-free is called the risk premium. But we're given the risk premium. What is the cost of equity
12%.
of the 4% of the 12% of the ungeared company is 12%. This is what we will use to discount our project class, to discount the base case NPV. We can move to the computation of the base case NPV. FPLC determination of base case net present value determination of base case class. The project is expected to last for how many years? What is the lifespan of these assets? The project?
4 years.
And tax is being paid in the year at which the profit is being made. So we need to inflate the sales by 8% and our direct costs by 4%. The interest rates, the interest used by a financial accountant is not relevant, right? It's not. So, sales revenue, all figures are in million or thousands. All figures, is it a million? Okay, but that's fine. So we assume, okay, yes, maybe it's a million, right? Should be. Okay, it should be a million, yes. Okay. Class, are we still together? Are we tired?
Yes, sir. Well, with you, sir.
So we can have this to be in million. Please, SFM is very simple. Just understand the principle. The principle is the rule of the game. And what is the principle? The steps. Once you understand the steps, your steps will become the ingredients you need to look for every question. If it is bond valuation, you ask yourself, what are the steps? In calculating the forward rates or the valuation of issue price, you need the forward rates to discount. When the forward rate is not given, you need to determine the forward rates. Or you can also use yield to maturity. So these are the ingredients you need in a question. Under the bond valuation, the same thing applicable to all other topics. I have all the steps in solving all the topics in SFM. Just follow the steps. You don't need anything. When they say adjusted present value, just look what are the steps. Then go to the question. Identify the ingredients that you will use. And that is why I said SFM is very simple. So sales revenue will be inflated by how many percent per year? Workings. I will just year one. I will do for year 1 and 2. What is the sales revenue given to us in the question? What is the sales revenue? 460.60. Class, are we still together?
Yes, sir, we're together.
Now don't give me figure now. 460.60 million times, it will be inflated by 1.08. Don't forget it's per annum. This is raised to power of 1. Year 2. What is the figure given to us in year 2?
732.
732 times 1.08 raised to power of 2 per annum. So you can do others, right? So I can put here to be inflated by 1.08. You can calculate for others, right? So you inflate it by 1.08 raised to power the numbers of years. So what do we have? The first year is what?
497.
497.
197.45.
497.45. Next, what do we have?
853.8.
853.8. What do we have here?
1236.28.
Please don't forget that they gave us the sales revenue that we are inflating. Inflate this and raise it to power of 3. Then inflate 4, raise it to power of 4. Class, what do we have here?
1038.38.
1,002 what?
36.
Oh, your network is
123 point
123
6.28
1236.28. So we can even approximate this. Okay, let's start. Right, this is 1, this is 4, this is this, please. So what do we have here?
738.47.
738.47. Okay, approximate, you have 738, right? This is 738. Thank you. So we have the direct costs. The direct costs to be inflated by how many percent, class? Direct costs.
4%.
1.04%. So this is for revenue, then direct costs. Direct costs, year 1. What is the figure for year 1? Direct project costs, 276.40, right? 276.40. It will be inflated by 4%, raised to the power of 1. What do we have here?
287.
288.
288. Year 2. What do we have? The cost
475.
175. 475 times 1.04 raised to power of 2.
Okay, sir, it was the
It's 435.
The answer is 475.
that is for year 2 is 475.
The answer 475 inflated amount.
I'm coming. What do you have here?
439.20.
439.20.
439. Right. What do we have here? What is the cost?
No.
The
No,
first
sir.
year is correct. That is 288 is correct for the first year. The second year is 439.20 times 1.02 raised to power 2.
439.20.
0.20. Yes.
Because of the sign, I just okay. Let's just ignore the, what do we have here?
475.
475. So you can do for others, right? So I can have less. The first year is 288. The second year is what?
475.
475. The third year,
662.
662. Please don't forget that is this one. You raise it to power of the numbers of years. You raise this to power of the numbers of years. Right? So the third one is what?
662.
662. 662. What do we have here?
381.
381.
81. So we don't have any information again. Right? We don't have any information. What we have here is interest. Interest is not allowed. Right? So therefore, what will be the cash profits before tax? Cash profits. What do we have here? When you subtract, what do you have?
209.
209.
2 what?
209.
209. What do we have here?
379.
379.
379. What do we have here?
574.
574.
574. 574. What do we have here?
357.
57.
357. Right. We have 357. So what is the tax? Tax is 20%, and it is being paid in the year at which the profit is being made. So what is the 20% of 209?
42.
42.
We have
42.
42.
76.
So what do we 76.
76.
What do we have here?
115.
115.
115. What do we have here?
71.
71. Is there any approximation we're supposed to do in this year 4 that we did not do? Okay, that's
No, no.
fine. Okay. So we have the cash profits. You can meet your mic. Cash profits after tax. So what do we have here?
167.
167. What do we have here?
303.
303. What do we have here?
459.
459. What do we have here?
286.
286. We have 286. So therefore, we need to calculate our tax savings. Tax savings on capital allowance. After that, we have the investments in machinery or investments. We have the investments. So what is the cost of the investment? I'll come back to what is the cost of the investments from the question? 760, right?
760.
760. 760. Then the sales proceed. Sales proceed. We should not forget that it will be sold at the end of the project. What is the sales proceed?
80 million.
80 million. We need to work our working capital. Working capital. So we need to do our workings. Determination of tax saved. Determination Class, are we still together? Determination of tax saved. We have the year, items, the capital allowance. Please don't write CAO. CAO means what? Continuous assessment. Tax saved. Then the tax due. We have the cost of the machine. Now, we're told, let's quickly go back to that paragraph. We're told that 50%. We should not equally forget that this is 760. Out of the 760, 320 is for plant and machinery, and it will enjoy capital allowance. The first year will be 50%. The first year will be what? Will be 50%. 50% on 320 plus.
160.
Because that is, thank you. Because that is what they said here, according to the question. A balancing allowance is available in the year the plant and machinery is sold. Plus, meaning that the 320 will only be the one to enjoy capital allowance. So 50% in the first year and 25% thereafter. So we can do 20. Wow. Okay. So can have here to be 320. 320. Okay. Let me just put it here. 320, 50% to be year one. Year one. Oh. Capital allowance, 50%. What is the 50%? What do we have?
160.
160. Right. So we can have 160. And the tax is 20%. So what is the 20% of 160?
32.
32.
We have 32. Tax is being paid in the year at which the profit is being made. So this will be paid in the same year. One. So we're told that 25% thereafter. So what is the tax written down value? What will be the tax written down value?
160.
160. So we move to year two. We calculate for year two. Tax written down value brought forward. 160. The capital allowance is 25% according to this question. What do we have?
40.
40.
We have 40. What is the tax saved?
8.
8.
We have
Yes,
8 in year two. Class. What will be the tax written down value?
120.
Tax written down value 120. Thank you. Year three. Tax written down value brought forward 120. The capital allowance
30.
30.
30. This will be 30. What is the tax saved?
6.
6.
6. This will be paid in year 3. Class. So what will be the tax? What will be the tax written down value?
90.
90.
90. Thank you. The tax written down value will be 90. You should not forget that year 4. Year 4. Tax written down value is 90. You don't need to charge capital allowance in the final year because they have a sales proceed. It is from the sales proceed you need to adjust your balancing adjustment. Please, at the last year at which you dispose an asset, it will not enjoy a capital allowance. And an asset that you disposed, you don't need to enjoy capital allowance in that year you dispose the asset. You can only enjoy capital allowance if you have what we call balancing allowance. So therefore, what is the sales proceed? What is the sales proceed or the scrap value?
80.
So we have 80. Do we have balancing allowance or balancing charge, class?
Balancing allowance.
Balancing
Allowance.
allowance.
Get balancing charge.
No.
Who said balancing charge?
No, I said, is it possible to get balancing charge?
Yes, it is possible.
How do
When you have balancing charge, you have to pay tax on the balancing charge. When you have balancing charge, it becomes your inflow. You have to charge tax. You can come here or when you have, let's assume you have a balancing charge of 80 naira, then you will now do what? You pay tax times, or let's say this is the 80 naira. You pay tax 20%. What is the 20% of this?
16.
We have 16. What is the difference?
64.
64. You've paid tax, balancing charge. So you take this 64 to your computation. After cash profit, after tax, you can put your balancing charge. Class. You need to charge tax on it. Mary, do you
Yes,
get?
sir, I'm here.
Do you get?
Yes, at the last year.
No? Okay, at the last year. Thank you. Yes, at the last year. At the last year, thank you.
Okay, thank you so much.
Yeah, you're welcome. So we have balancing allowance. Balancing allowance. So this will be your capital allowance. Don't forget that balancing allowance is type of allowance. If not now that we don't have the Finance Act, the new Finance Act, we don't have initial allowance. What you have now is annual. So what is the 20%?
2.
You have 2. will be paid in year 4. So therefore, please, you give me the tax saved figure. Year 1, what do you have?
32.
32.
32. What do we have here?
8.
8.
8. What do we have?
6.
6. What do we have?
2.
2.
2. So we go to the calculation of working capital. Working capital, year 0, 1, 3, 4. And we're told that working capital is how many percent of sales?
20%.
Of the anticipated sales. Class. 20% of the anticipated sales. So we can have sales or revenue. So I need to copy the revenue for each of the anticipated. So we can have our working capital. Working capital. In another case scenario, the examiner may say that your working capital for every 1 naira increase in your sales will be your working capital. Don't be confused. For every 1 naira increase will be your working capital. For every 1 naira. Examiner may say that from 497 to 854, what is the increase? The increase is your working capital. In that case scenario, when the examiner says that for every 1 naira increase in the revenue, you charge, or for every, there are 2 case scenarios. For every 1 naira increase in your revenue will become your working capital. So you can look for the difference of this. It becomes your working capital. In another case scenario, the examiner may say, for every 1 naira increase in the revenue, charge 10% to be your working capital. Class. Meaning that if we increase this from this, the difference between this and this, let's say it is 50, you need to charge 10%, for instance, on every increase. Class. You may also see that case scenario. So in this case scenario, please mute your mic. Sorry.
Sorry, sir.
No problem. That's fine. That's fine. That's fine. So we have working capital to be how many percent? 20%. What is 20% of 497?
99.4.
99. I may approximate at the end. But since I'm using this, should I approximate now or later? Okay. What do you have here?
170.8.
No, just give me the full figure. 17. Okay, don't worry. 99. The next one is what?
171.
171.
171. Next.
247.
247.
247. Next.
148.
148. Right. So before you will now do your changes in working capital class. Sincerely, SFM is very simple. Understand the principle, please. And stay away from people who have negative energy. They will tell you everything is difficult. Nothing is simple. They will tell you everything is difficult. It is not. It is not. Please. Now, from year 0, you have 99. Your working capital has increased to 99. So therefore, you have increase in the working capital from 99. From 99 to 171. What is the increase?
72.
72. It will increase in working capital, will reduce your cash flow. We'll get there. We'll get to free cash flow. When you 171, what is the increase?
76.
76.
Thank you. What do we have here? What is the increase?
99.
99. It is not an increase, right?
Yeah, it's an
76
decrease.
negative, yes.
Okay. It's a decrease, 99. In the last year, 148 minus 0. You recoup back your investment. You have 148. If you had all this together, if you had 99 plus 72 plus 76 minus 99, you will have 148. So this is our working capital. Do you have 148?
Yes, sir.
Thank you. So 99 is our working capital. I plan to finish this first question, but that's fine. Year 0, 99. Year 1, what do we have in year 1? Year 1, working capital.
72.
Okay, see it. Look at it. Look at it, class. 72 negative. What do we have here?
76.
76.
76 negative. What do we have here? What do we have here?
99.
Positive, right? 99 positive, right?
Yes.
Okay. The last one is also positive. So what do we have here? Please. What do we have? Quickly, please.
859.
859. What do we have here?
127.
167.
127.
127. What do we have here?
235.
235. What do we have?
564.
564. What do we have?
516.
516.
859 is
859
negative.
negative, please.
The last one.
No, the
859.
zero.
First one. Year 0.
Okay, year 0. Okay, thank you. That means I need to eat too. But that's fine. So we have to discount using the money cash flow given, money cost of capital given to us in this question. What is the money cost of capital given to us in this question? 11%. Class, don't forget, if the examiner wants to change this question, you can mute your mic, please. If the examiner wants to change this question, they may not give you the money cost of capital. They will only give you real cost of capital. Knowing that what you have now is money cash flow. So you need to convert your real cost of capital to money. You can see that the general inflation is given as 4%, where you will use to convert. In fact, if you convert this, you should have 11%. You should have what? 11%. So therefore,
sir, what about the KE that we calculated at first? I thought is what we are going to use, sir.
Why will you use KE? Thank
KE,
you.
your cost of equity on geared.
Thank you.
12%.
Thank you. Thank you. Thank you. Honestly, I forgot. So that's fine. Thank you. 12%.
So that clause was just there to confuse us.
Yes. So why do you have to give us that clause there?
When I don't know, it is of no use. Class, because this is APV. Class, it is of no use because this is base case MPV. You can only use it when you want to determine your normal MPV without base case. That is when you will use 11% to discount it. But because we are calculating base case, remember, this is adjusted present value. Thank you for that question. Since it is adjusted present value, we have to use the cost of equity of the ungeared company. If it is the normal MPV, you can use the 11% because money will goes with money. So the 12% we calculate here, it assumed to reflect the money. That is why they say we should use the cost of equity of the ungeared company to do what? To discount. So what do we have here? Thank you. What do we have here? Quickly, please, class.
0.89.
0.89. 3 decimal. What do we have here?
0.797.
0.797. What do we have here?
0.712.
0.712. What do we have here?
0.636.
0.636. So what will be the present value? Present value. 859. What do we have here?
113.
113. What do we have here?
187.
187. What do we have
402.
here? 402. What do we have?
328.
328. Class. What will be the present? What will be the MPV?
191.
What will be the base case? Sorry. Base case. MPV. Equals to what? What do you have?
171.
171
171.
is a million, right? 171 million. That will be the base case. NPV. The base case is positive. Class. So we'll proceed to the PV of financing effects. That is the second item. PV of financing effects. The first thing you should identify is the sources. Sources of finance. So let's go back to the parts where they mention the sources of finance. I can copy. Let me just copy this so that we don't need to scroll up, right? So the sources of finance. The sources of finance. Then before this paragraph, they gave us, before the paragraph, they gave us interest of this. So let me equally copy this to make our work easy. Now, class, the first part is how the project is being financed. We were told, please, who have question for me? Any question before we move? I'm seeing something.
Yes, I have a question, sir.
Okay, go ahead.
Assuming when we calculate our KE and we have like 12.8, and now approximate it to 13, then use 13 to discount instead of 12.8.
Yes, you can use it. You can approximate. Thank you. So, the sources of finance. It is anticipated that the project will be financed entirely by debts. Oh, Bashirat. Okay.
Okay, so I have a question.
Okay, go ahead.
It's concerning, for example, if we have better of equity for the, we don't have any information about the Proxy company. Like there's no better of equity, there's no better of assets, there's no value of debt for Proxy company. But we have the one related to the main company. Can we use that main company to determine the cost of equity of the on-get company?
Yes, you can use it. There is a clause that the examiner will write that you need to take note. You can use it, but take note of that clause. And what is the clause? Don't worry, I won't tell you the clause. Go and solve that question 1 of that pilot. I know where you get it from, but that's fine. But you just go and check it. You can use it, but there's a clause there that the examiner writes, right? There's a clause there you need that makes you to use that that particular word information. Thank you, Bashir. So it is anticipated that the project will be financed entirely by debt. Class, if a project is financed entirely by debt, it will include the working capital. Because how we then now get funds to finance to do the working capital if a project is being financed entirely, right? Meaning that including the working capital itself, it is being financed by debt. Class. So therefore, total investments for the projects. What is the cost of, what is the working capital at year 0, or what is the total cost of the investment is 720, right?
760.
Okay, 760. 760 plus, what is the working capital?
99.
99. So what is the total cost of investment?
859.
859. This is what we're looking for. We need to look for it. How we will finance this 8 million. You can see that in the previous example, we're not told that the project is being financed entirely by debt. If any project that is being financed entirely by debt, it actually includes the working capital because they don't have money. The question I will ask is that where did they get working capital? The funds for the working, where did they get it? So that is why it is financed entirely by debt.
Sir, please don't be angry. That 99 million, I don't know how we got it.
What is the working capital at year 0?
Okay, thank you.
Okay, that's fine. Okay. Subsidized loan first. Toyib, are you still with us? Subsidized Toyib loan. 60%. 60% times 859. What do we have? What do we have?
515.4. What's it?
5. We'll put the 0.4. Don't worry. When we want to put it in, we want to use it in PV, we can do that. We can approximate, right? 5.4. 515.4 plus. What would be the rate? Let me put it here. Rate now for the subsidized rate. We were told that of which will be obtained from a subsidized loan scheme run by the government, which lend money at a basis point of 100%, 100 basis points below the government yield of 22.5%, below it plus. Or let me analyze it this way. Yeah, 100% divided by 100 equals to 1%. So it is below it. So the rate now will be 2.7% minus 1%. Now, what is the subsidized rate? What will be the subsidized rate?
2.5%.
Is it 2.7 or 2.5?
2.5. Thank you.
1.5.
1.5. Now, that is the reason why it was stated here in this paragraph that interest is based on FPL normal borrowing rates of 150%, 150 basis points over the 10-year government yield. If you do 150 divided by 100, you will have 1.5%. Is that not so?
Yes, sir.
That is it. Class. That
Hello,
is
sir.
it. Yeah, I'm with you.
Please, sir, this 99 million, is it the working capital in year zero that you added to the total investment?
Yes, please. Plus, that is the normal borrowing from the government. What they borrow, what the subsidized rate. That is the reason why the questioner still go further and say, which land though money at a rate of 1% below 1% mean below this 2.5. Below it, the difference between 2.5 and 1.5 we give them, or the normal borrowing from the government will be 1.5% using this information here. Why government normally they give at 2.5, but they now subsidize it for them to be 1.5. Now, the balance, there is issue cost, right? We are still analyzing how they will source for the 085 this thing. Now, the balance will be the which is the balance of 40% will be funded from the normal borrowing sources. Plus, if 60% is subsidized, the 40% will be on commercial. So commercial debt is equals to 40% of 859 million. The main problem of our PV of financing is how to analyze this subsidized loan and all these things. So any other information, yeah, we are good. So what do we have here? What do we have?
343.6.
We have what?
343.6.
343.6. Class. Now, we should not forget that the government is giving at government rates. Government is giving at 2.5. But we will subsidize it and give them 1.5, which is below the 2.5. In this question, commercial rate is not given. Now, the question now is, how do we determine the commercial rate? Class, how do we determine the what? The commercial rates. When you want to determine the commercial rate, you look at commercial rate in the perspective of bank. Now, the basis points that bank is lending at 32% or 31% basis point is above the MPR, monetary policy rates. So meaning that the commercial rate has included include the subsidized rates and the subsidized rates, right? And the MPR rate to give us that 30% that the bank is lending. Class, please, am I communicating, please?
No, sir.
No. Let me explain again.
Take it back.
The bank is lending at 30%. If bank is lending at 31%, and the MPR rate of 27.5% is not subsidized, so that is the normal government rate. It is what? 27.5. And we still have subsidized that the government will now say, oh, this is what we are doing, but we'll give you guys this. Now, what I'm saying is the commercial rate of 30% that, or 32% or 31% that the bank is lending as of today as include the MPR. You know, MPR is 27.5 and they are lending as 36. Is that not included? Is included now. Is that not so? At the same time, if government is giving a subsidized loan now, we have a lot of loans now. They will tell you they will give you 2%. That 2% is also included in the commercial rate. Class, is that not so? Class, is that not so?
Yes, sir.
Thank you. So meaning that the commercial rate include what the government, the MPR, 27.5% is in 31% now. You can see it in 31 basis points. At the same time, if government is giving a subsidized loan, right, of 2%, it will still be included in the commercial rate. Meaning that your commercial rate includes the MPR 27.5% from the government and what they subsidize for farmer. So therefore, the government rate given to us in this question is the MPR. Then the subsidized, they now give it to them. This is what we learned though. It is 27, it is 2.5, but we'll give it to you guys 1.5. Then the addition of the MPR and the subsidized rate will give us what we call commercial rate. Class, am I communicating, please? Class, am I communicating? Right. So we can move and say your commercial rates. Commercial rates. When you add these two together, what do you have? Addition of this 1.5 plus 2.5.
4%.
4%. We have 4% plus. So when you add this together with subsidized loan and the commercial loan, the amount, right, will give us the total investment cost, which is 859. So having analyzed these sources of finance, we'll move to our step-by-step to identify the issue costs. Class, the government rate here is your MPR. Today, we have MPR of 27.5. That 27.5 is not a subsidized rate from the government. Government will still give you a rate below that for them to encourage farmers. Right? Now, the addition of this will result to as what a commercial rate, meaning that in your commercial rate in the bank today, it includes the MPR and the subsidized rates from the government. Class, am I communicating, please? So in this question is actually different from what we've been doing, because what we did, because the commercial rate they're supposed to give us, but the question wants to test our knowledge on how the rates work. Class, are we good? Are we good?
So
what is it? What is the question, please?
So a note in note 5. What's the relevance of it? Because we are going to use that note 5.
I'll bring it here. Maoga, I'll bring it here. That is why I said 150 basis points divided by 100 we give you 1.5%. And this is the 1.5% of the subsidized. This is it here. This is it here. Don't forget that they said it is normal. It is normal borrowing rate of 150 basis points over the 10-year government yield. Government.
I thought that's the commercial. That should be the commercial.
It's not a commercial rate. Commercial rate will not be government yield. Commercial rate cannot be government yield. Commercial is what the bank does not relate to government. It is what the bank is charging you. They've mentioned government yield rates. That is what the government is giving to you as a subsidized. And don't forget that in the next paragraph, they now say which lend money at a rate of 100%. You can still get other 1.5% by saying that, okay, if they lend below that, definitely we have 2.5. 2.5 minus 1%. We still have the same 1.5%. The commercial rate, that is why I use practical illustration, that commercial rate is what the bank is lending you. What the bank is lending you, right? Include the yield, include the MPR of 27.5%, and the subsidized, they give loan to farmers now. The loan they are giving to farmer will be below the 27.5%. So the addition of the loan they give to farmer as a subsidized plus the MPR will give us what we call commercial rate. And that is why when you go to the bank, we have a rate. Class, am I communicating? Right? Are we good?
Yes.
Okay. So, what is our first step? Step 1. Issue costs. And what did they say about issue costs? Issue costs related to raising the finance are 2% of gross finance required. Issue costs related to the rising of what? Finance. Don't forget it is being financed by what? It is being financed by what?
Debt.
By debts. So the issue cost will be applied on it in rising the finance. The debts include the subsidized and the commercial class. In rising the what? The finance class. Rising the what? The finance. Raising the what? finance. So we can have either you call it a subsidized or a cheap. So this subsidized loan is 15515.4 M. Issue costs of 2%. So that is 2 divided by class 2 divided by what? 98 times 515.4. What do we have? What do we have here?
10.52. 10.52.
Okay, 10.52. 10.52, right? So when you add these two, what do I have? The gross amount. What do you have?
525.92.
525.92. Yes, we'll approximate when we want to plot it in our table, right? This will be at year 0. This will be at year 0. Commercial. Commercial loan or debt is 343.6. No doubt, the only part that is technical in this adjusted present value, usually adjusted present value, where you will see the part that is so technical, right, is the part of the sources of finance. You need to understand how rates work practically, right? We need to understand how it works by saying that we have the MPR, we have the subsidized, we have the commercial. When you had even practical, let's look at it practically. The commercial rate in the bank as of today include MPR and the subsidized rate. So addition of this, we give the commercial what? Commercial rates. Now, issue costs 2/98 times 515.4. What do we have here?
It's 343, sir.
Sorry, it's 343.6.
Okay. Oh. Okay. Okay. Oh. 0.6. What do we have here?
7.01.
7.01. What do we have?
350.61.
Okay. Gross amount. Please practice make perfection. Please go back to it again. 350. 35 what?
0.61.
0.61.
Right. Please go and check the past question. The first question we solved in class was tested in one of the diets. Right. You can check. I think the only time you can see adjusted present value is just 2 diets. Let's check 2 diets. You see it. It's just in 2 diets. Meaning that ICANN is here to test question on adjusted present value for some diets now. Right. So step 2. Tax savings. Tax savings on issue costs. Doesn't mention. So we assume issue costs. We assume that tax savings will be on the debts. On the debts, entire debts. Debts. You should not forget that if you have a tax savings on issue cost is usually should be on debt, right? So, but if the question did not state, right, and you have the sources of finance to be equity, right? To be what? To be equity, is that also? So, to be equity and debt, you will just choose the tax savings on issue cost alone, right? Tax savings on issue cost on the what? On the debt, on debt alone. But in this question, we're told that the project is being financed by debt. So the tax savings will be on the entire debt. The tax savings on issue cost will be on the entire what? Entire debt. Both the subsidized and the what? And the commercial. Right. So what is the issue cost for the subsidized? 10.52 plus 7.01 times 20%. What do we have? What do we have? Figure, please. Away.
3.51.
3.51. We assume to be year 1 because that is the year you start charging tax after your year 0. After year 0 is year 1. That is when you started the projects, right? Year 1. Step 3. Class, what is our step 3?
Tax savings on interest.
Tax what?
Savings on interest costs.
On interest. Right? On interest. And we have the interest to be on commercial, on subsidized of 1.5, and we have commercial to be this. And I said this is your MPR, monetary policy rates. Right. So interest, we have interest on commercial and on subsidized. right? So therefore, we can have commercial equals to, what is the gross amount? We have the gross amount of the commercial. How much is it? 350, right? Hello? 350, right?
Yes, sir.
Yes.
Yes, sir. Yes,
Why?
sir.
Why? Because this is the entire amount you will borrow. I said it in the previous class. When you want to borrow 50 naira from me, you will need to consider what are the costs. You will now add everything together, then charge interest on it. That is what it means, class. So usually is the gross amount, right? Because what is the gross amount? 350.61 times, what is the interest rate on commercial? What is the interest rate of commercial?
4%.
4% times the tax, which is 20%. So what do we have? What do we have?
2.8.
2.8. And tax is being paid in the year at which the profit is being made. It is not in arrears. Therefore, the project is for how many years? 4 years. So tax savings from year 1 to 4. Don't forget, if it is in arrears, it will start from year 2 to 5. So subsidize. Subsidize rates. Usually, we don't normally have the gross amount because of the nature of the question, that it is entirely financed by debt. That is why we have issue cost on subsidize. Plus, if we look at the first question we solved, under the interest, tax savings on interest costs, we use the entire 515.4 because there is no issue costs on subsidized loan. But because of the nature of this question that says that the project is being financed and the issue cost is raised to what is being used to finance the project, that is why we have the gross amount, the issue cost on the subsidized loan class. So we use the gross amount of 525.92. 525.92, right?
Yes, sir.
Right? Times, what is the rate of subsidized? What is the rate of subsidized? What is the subsidized rate, class?
1.5.
Thank you.
1.5.
Thank you. 4% or 1.5 times 20%. And let me tell you something today. And I'm okay. Let me just say, I'm not all SFM tutor. We bring this type of question in class because they know, I know that the question is complex. No, in the parts of the sources of finance, if you don't have the knowledge of how the rates move, right? Particularly in our economy, you will not be able to analyze the question. Yes, class. So now, Latifat, refer to what we did in our previous class, please. Right? You said tax savings will only be on subsidized rates. How now? They say tax savings on interest costs. Where did you normally see interest? You see interest in commercial and subsidized. So why will you apply tax savings on interest costs on only on what? On subsidized? What about the commercial rates? Tax savings on interest. Where can you see interest? Forget about the tax saving. Interest is on both commercial and what? And the subsidized. So what do we have here?
1.58.
1.58. Latifat, do you get that?
Yes, sir. Thank you, sir.
Thank you. So what is the addition? Please refer to the previous video, right? You need to watch it, like go back again and check what happened there. So what do we have? What is the total? Hello?
4.38.
4.38.
0.38.
Plus. So it will be from year one. Let's say the total. We'll just use the total. So please, what is the next step? What is the next step?
Subsidized interest.
Tax savings on interest. I like the way you've rebrand your step. It makes sense. Whichever one that will be convenient for you, you're good. Tax what? Tax saved on interest. Meaning that between the subsidized and the commercial, how many percent did we save? Instead of going for the commercial, we say we have subsidized of 1.5 and we have commercial of 4.4%. How many percent have we saved? That is what it means. That is why I said SFM is not difficult to just understand what you want to do. Understand why it's like this. Tax saves, right? Tax saved on interest, what? On interest. How much did you save? Is that not so? Is it our first step? Is it tax save or savings on interest?
Savings on interest cost.
Okay, sorry. Savings, thank you. Savings on interest costs. So we have 4% savings minus 1.5%, right, class? 1.5% times what?
5 to 5.
Times what?
The gross amount.
Is this supposed to be gross amount? Is this supposed to be gross amounts?
No, sir. It's the 515.
515.4.
515. How much did you save? Plus the commercial. We are talking about savings. We are not talking about the entire costs. We are talking about, that is why I say costs. We are talking about savings on interest. It's supposed to be 4. you have 1.5 class. The difference between the two is your save. Then it will now be on what? On the cheap or on the what subsidized amount, which is 515.4. Look at it here. Now, previous lecture, let me quickly show you. Just in case you didn't go back to it, please always go back to, can you see? 300 million. Where did we get the 300 million? It is not on gross, it's on the cheap. Can you see? Because it is savings. Because it is what class? It is savings. Please understand the meaning of whether it is tax savings on interest cost or tax save on interest. On interest. Savings on interest. So 4.5, 4% minus 1.5. What do we have? What do we have, class?
2.5.
2.5 times 515. 515 point what? Class 515.4. Okay, point. So what do we have?
12.89.
12.89. Class. This is not, you can mute your mic. You can mute your mic. Okay. Now, this is not tax savings. It is savings. You will save 12.89. You will save all these things. That is what you will save. Then you will save it from year 1 to year 4. Right? Because it is savings. Now, step 5. What is step 5, class?
Tax paid.
Tax paid, interest saved.
Tax paid on interest saved. Meaning that you've saved this. You have to pay tax. So tax is 20% of 12.89. What do we have?
2.58.
2.58.
58.
2.58 class. Because tax is not being paid in arrears, it's being paid in the year at which the profit is being made. So we have from year 1 to 4. If tax is being paid in arrears, we have from 2 to 4, 2 to 5, right? 2 to 5. So we are done with this. So we need to plot the PV of financing effect. Let me quickly copy this. The PV, where is itself? The PV of financing effects. The PV of financing effects. So we have the PV of financing effects. Okay, go ahead. Mute your mic. Or mute your mic. Go ahead quickly, please.
Okay, good afternoon, sir.
Good afternoon.
I want to know where the 2/98 of that subsidized loan was.
Were you in class?
Yes, I was.
Were you in class? Were you in
Yes.
class in our previous class?
Yes, sir. If I wasn't, I reviewed the video.
Okay, 2 point what?
No, 2/98.
I've explained that in the previous video, in the previous class, right? This is the net amount. You said, that is why I said practically you need 15 naira. In this 15 naira that you need, from this amount here is what we call the net amount. Net amount means that there is issue cost here is inclusive, or the issue cost has not even been considered yet. Then the cost of raising the fund is 2%. You need to look for how you will get 2%. You need 15 naira. Before you can raise 15 naira, you need to look for maybe 100 naira. That is 60 naira. Cross it up so that you will have a gross amount of this. And that is why it's like that. Do you get?
Thank you.
So, Michael, if you know you are not in the class, in the last class, okay, you can unmute your mic. Mike.
Good afternoon, sir.
Good afternoon.
Good afternoon, sir. Yes, I want to ask the savings that we calculated, is it going to be on the net amount of the subsidized loan or the amount of the subsidized loan?
What was that? What was that?
The step 4, the savings.
I'm coming. Savings.
Yeah, the step 4.
Yes, it's not on the gross amount.
Net amount.
It's on the net amount. Yes, net. That is where you save. That is what you save. Right? That is what you save. So, what is the commercial rate that we will use to discount it? 4%. So, issue costs. Class, what is the issue cost? We can approximate here, or we can just bring the figure as approximation. So we can move. Class, oh yeah, now you can screenshot. Let me scroll to the part of, okay, can you see it? So issue cost. So we have issue cost. Issue costs. We have issue costs on subsidized. So what is the issue cost on subsidized? Please, who is giving me
10.52. 10.52.
10.52. So we'll be at year 1. We have 1. So we can have 10.52. So what is the issue cost on the commercial?
7.01.
7.01. We have 1. So we can have 7. So what is the tax savings on issue costs? What is the tax savings? Okay, thank you. 3.51. So what is the DCF? Year 1, 5%. Year one, 5%. What do we have?
0. Okay, for 4
Zero
years.
point
I
nine
believe
five two.
0.9952.
952.
Okay. Oh, it's
Sir, sorry,
4%. Oh, sorry.
4%, not 5.
Okay, it's 4%. Sorry. Commercial rate is 4%. Check it again, please.
Zero point nine six two.
0.962.
0.962. So we use how many hours? Oh, God. So what do we have here?
Three point 3.38.
3 point what?
38.
3.38. Right. So we have tax savings. What is the next step, Self? I think I made a mistake. What is the next step, Self? The next step is tax savings on interest. Okay, interest cost. Okay. Tax savings on interest costs. Tax savings. Let me just remove this. So what is the tax savings on interest costs? 4.38, right?
4.38, yes.
4.38. And it will be from year 1 to 4. So what is the annuity? What is the annuity? What is the annuity?
3.630.
3.360.
3.630, I meant to say.
3.630. Please, our first class on adjusted present value. Check. I think it was added to, is it decision tree or what, Self? That first class.
Yes, decision 3.
Yeah, decision tree. Check decision tree and adjusted present value. You will see it there. The first class on adjusted present value. Check November 2025 SFM. Search for decision tree. Under the decision tree, you will see there decision tree and adjusted present value. That is the reason why immediately after this, when we finish this question now, the option pricing, we have to stop the stream, right? The streaming, so that we can have a fresh what is it called? On option price, right?
So I think November or May.
No, November. Which one is that? Is it the decision tree?
Yes.
No, it's November.
Which year?
No, I mean the last what is it called? The last class I used decision tree and adjusted present value.
Yes.
For the video.
Okay.
Do you understand? Meaning that when you want to search for the adjusted present value part 1, you can't get part 1 because it includes both decision tree and adjusted present value. Do you understand?
Yes, sir.
Okay, thank you. So what do we have here?
15.90.
15.90.
15.90.
15.90. So what is the savings? Savings on interest. What is our savings? 12.89. 12.89. 12.89 from year 1 to 4. So we can still have 3.6 for your annuity, when you multiply, what do you have? If you multiply, what do you have?
46.79.
46.79 plus savings. Then lastly is a tax paid from year 1 to year 4. Will be on brackets, will be in brackets 2.58, 3.630. What do we have here?
9.37.
9.37. What is the PV of financing effects? Is it positive or negative?
Positive.
What do you have?
39.17.
39.17. So I need to copy the base case MPV. The base case MPV is 171. The base case MPV is 171 plus 39.17. What do we have here?
10.17.
0.17.
0.17.
So therefore, the project should be accepted because it has a positive MPV. Please make sure you solve question on APV. 1. Check past question. Of course, there's one of the APV that we'll solve that one during our intensive. Sir?
Mr. Ibrahim.
Sir?
Let's confirm that the PV of finance, that 39.17.
You can confirm that, right?
What I'm having is 57.91.
It's
What do you have?
correct. It's correct. 39.17.
Correct. It's 39.17.
So please check again. Please check. We are done with this question. This is how many marks? Think about 14 marks.
22.
Just 14 for this long process. Now, wow.
22 marks. 22 marks. Then you should comment on the correction. Comment on what's the correction you've made. And include any assumption. Just comment to the original MPV, right? Talk about the interest. Interest is not allowed under the base case MPV. What they're supposed to use to discount supposed to be what is it called? The cost of capital of the ungeared company. Right? They use 7%. Right. And the basis of assumption, don't forget that the basis of assumption. Do we have any basis of assumption here? So any basis of assumption you observed, please write. right? So as far as I'm concerned, even my body know the adjusted present value again. So class, are we still together?
Yes, sir.
Yeah. Please, you just need to solve question. The more you solve question, the more you know that, okay, the more you are familiar with all these jargons. And will this be the worst case scenario? No. You may still see another question. Right. So please, if you have question, unmute your mic. Then I have to introduce option pricing. So I think I need to stop the streaming so that we can start option pricing. Or should we go for a break? Because the class will end at 3 p.m.
No.
Let's go for question.
Yes, let's go for break.
Let's continue.
No break.
No break. No time.
Okay.
Drink water.
Yes. You can take
10
water,
minutes.
actually. Yeah, you can. Let me stop the streaming so that we can start. Option pricing. Option pricing is another interesting topic. Please, we have lecture on Monday. Every Monday we'll be having lectures now, please. 8:30. 8:30. So please, immediately after this class, go back and check. Understand the step. First, understand those steps. Why is it like this? So when you understand, you listen to this, then you understand why it's like that. So you can now solve more questions. Don't forget the theoretical parts or theoretical aspects of the strategic management model, the risk management, the corporate governance. Of course, my boss is doing justice to that, right? Yes. So, and you should not equally forget that it will be an application. I will not ask you what is risk management. In the application of a question where a given scenario, you have to identify a business risk. You have to identify the credit risk. You have to identify the liquidity risk that may affect the objective of the company. And that is the application. And these are what we this scenario where we'll bring it during our intensive class, then we look at it together. Okay, you may have this, you may have this, you may have this, and this is the application. It is still what you will know, like the corporate governance. All right. To start new. Yes. Yes, I will do that now. Let me do that.
Well,
So-
hello, Mr. Ibrahim. Sorry to cut you short. Please, concerning the assignments that you gave us,